DXY, you guys know how I feel about the DXY. Again, we are back on top of the 200 exponential and simple. The 200 exponential and simple have rolled over to the upside. They both have a positive slope. And while we are in a temporary little micro downtrend, we have a low back here. We have a higher low here. We have a higher low here. And then obviously the macro low here. So looks to me like everything is bullish on this. We're clearly above both moving averages, 200 and simple, 200 and trending to the upside. So while we're seeing some temporary bearish divergence play out, I do expect this to continue to the upside. I do expect the dollar to gain strength over time. And again, if we just turn on our drawing tools real quick here and pay attention to what's taking place, we have two very clear patterns taking place. We have an inverted head and shoulders with a slight descending neckline, or alternatively we have a rounding bottom or an eve bottom right here, and then a pointy bottom or an atom bottom right here for a double bottom pattern. Either way, depending on how you look at it, we have a measured move somewhere if we break through the neckline here in white, or technically if you look at the descending inverted head and shoulders, we have already broken through the neckline and we're just consolidating on top of it. But either way, our measured move is going to take us roughly somewhere between 96.5 to 98. Also, obviously, we were operating inside of this little ascending wedge, broke down from it, found support at the bottom of this ascending broadening wedge, and now we're potentially coming down here to retest that in the neckline, at which point in time I would expect us to move back up towards the top of the range. But as far as I'm concerned, we're just range trading, consolidating, but very bullish on the daily. Very bullish. And then if we look at the weekly, we will see this is a macro support line / resistance line that we've been paying attention to, and that's why we're having difficulty breaking through it. But I do expect over time that we will break through it. We'll notice here on the weekly that we were in a long uptrend here, saved the uptrend here, and then lost the uptrend here, and that a break back to the upside would be the retest of the 200 exponential and simple, which we are below currently. But we'll notice also that we're seeing a bottoming pattern play out, as here we have a double bottom. Here we have crossed 821 back to the upside on the weekly. Here we have triple bullish divergence from this point, and this point, a same high. Same lows, and this was obviously a higher low. We have a lower low, we have a higher low, we have a higher low, we have a low, we have a roughly same low here, and then a higher low here. So we have the two different types, hidden and regular bullish divergence playing out, 3 drives of it, followed by the move back up, and then we took out basically this little previous peak from the initial move. So as far as I'm concerned, while we are still below the 200 exponential and simple, I'm still bullish on this for a retest back up to roughly 94 to 94.8 or 95. So again, that's going to be part of the measure move, but not the completed measure move. And then finally, if we just switch out to the monthly time frame, here on the monthly, we will see this chart goes back till 1985. We are very clearly in a downtrend on the dollar. We have an initial peak back here. We have a lower high here, and then we have a series of lower highs here as well. We have a low right here in 92. We have a low again in 2008. And now what we're paying attention to is, very clearly over time this is going down, but we have an internal retracement from this point all the way almost back up to the previous high. And I say internal retracement because we have a high and a low, and then we move almost back up, and then finally we break out of the internal retracement. We take out the low. Alternatively, we could have broken into the upside and took out the high. But again, we're in a downtrend now since then. When we took out the low right here, we're now in an internal retracement of that low. So we have a low, and then as long as we're below this high here, it's still technically internal. But for the first time on this chart, because it takes so long for our monthly 200 exponential and simple to populate, we took out the 200 exponential back here in October of 2014. We moved on top of it, came back down and retested the 200 exponential and simple in 2018, but still had a negative slope on the 200 simple because on a monthly it takes so long to respond. And then here we got extremely bullish on the dollar long term, but still expected a pullback, as here for the first time on this entire chart going back to the 1980s at the end of, think about this for a second too. What was going on now? At the end of December 2019, beginning of 2020, we confirmed the 200 simple and 200 exponential slope to the upside for the first time. So macro, we were bullish on the dollar for literally the first time ever. Arguably, you could say if you extended out the 200 exponential and simple, that you would have got the same signature back here in like 97. And we went for roughly a 30% move to the upside, and that lasted for 2,038 days from when this previous similar situation took place. So, or arguably, let's say you're saying, oh, well, no, the 200 would have been roughly around here. That's fine. 25% and roughly 1,186 days. So from when we confirmed this trend to the upside, we pull back to the 200 exponential and simple. But if we get roughly, 2,000 to 1 to 2,000 days of an uptrend, we're talking about an uptrend in the dollar till roughly 2024, 2025. That's not possible. Federal Reserve and inflation, and they're printing too many dollars and blah, 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 blah. Sure, fundamentally, you can argue whatever you want. But technically, the dollar is probably going to rip people's faces off. And what is that going to correspond with? Probably a massive crash in all markets. It's going to be a crash in the real estate market. It's going to be a crash in, possibly commodities, gold and silver, etc. Probably a massive capitulation event in cryptocurrency and the stock market. Probably a crash of a bunch of other currencies around the world. And you say, but the dollar's garbage, da da da. Well, it's still the world reserve currency. So at some point in time, if you owe a debt to someone, if you have an IOU that's, in anything, say you have an IOU to your buddy in Mentos, I owe you 1 pack of Mentos. And you're like, okay, and if anybody doesn't know, they're like those candies. But you could say anything, Tic Tacs, whatever. I owe you a box of Tic Tacs. Okay, cool. And then finally I come to you one day and I say, okay, here's your box of Tic Tacs. I would like to settle that debt. You're like, okay, great. Now we're even because you owed me a box of Tic Tacs or whatever, package of Tic Tacs or, a Pez dispenser or a pack of Mentos or whatever currency you're using for your deal, for your IOU. If I come back to you later on, though, and I say, here's $1, and you owe me a pack of Tic Tacs. You don't owe me $1. I could say, no, I don't want it. I want the $1 or I want the Tic Tacs that you owe me. And then you go to the store and you say, well, Tic Tacs are only $1. And then you go to the store to buy some, and now Tic Tacs are $5. Well, you actually owe me $5 then because our debt was denominated in Tic Tacs. So the world reserve currency has debt all over the world in dollars. The entire world has debt denominated in dollars. A bunch of the mortgage securities or mortgages that were recently sold or that were recently defaulted on, or the treasury for Evergreen, the Chinese real estate company that just blew up, were denominated in dollars. So in order to settle those, in order to pay off that debt, you have to first acquire dollars and then pay it off the same way you would have to acquire a pack of Tic Tacs. So if you owe me a pack of Tic Tacs and then suddenly there's a shortage of Tic Tacs all around the world and Tic Tacs start going up extremely fast, and then all of a sudden a pack of Tic Tacs is $100 and you say, oh, here's $5. That's how much Tic Tacs were when we made the deal, or $1. That's how much they were when we made the deal. I could say, no, you owe me $100 because you owe me a pack of Tic Tacs. And that's what our debt was denominated. So that's the same way with dollars. So if all of a sudden this dollar starts to blow up and go to the upside, and then everybody FOMOs in, there's basically a short squeeze on the dollar because everybody who has dollar debt denominated in dollars needs to rush and get these dollars. That would lead to basically a short squeeze, an AMC pump, a GameStop type pump in the dollar. Does that mean that the dollar is amazing and great and everybody wants it? Well, no, we know for sure from what's happened with AMC and GameStop that horrible, terrible, shitty things can go massively parabolic to the upside. So that's your example of a dollar short squeeze, the same way that some piece of shit company that's basically bankrupt, like AMC or GameStop, can have a squeeze that goes up absolutely parabolic. We could literally see the dollar do the same thing. Well, yeah, but that's different because the AMC and the GME, that was a short squeeze and their companies, and okay. It doesn't matter. If people all of a sudden want something and there's a big short interest on it, or there's a limited supply of it, whether it's AMC stock, whether it's GameStop, whether it's the dollar, if all of a sudden everybody needs it and it starts to go parabolic, it's going to create excess demand for that. And that is how the dollar goes absolutely parabolic and wrecks everyone's faces. So if all of a sudden everybody's so sure the dollar's going to zero and hyperinflation and buy your gold and buy your real estate and buy this and foreign debt and this, that, and the other, if all of a sudden the dollar just goes absolutely parabolic, it's going to wreck anyone that's leveraged. It's going to wreck anyone that doesn't have dollars. So maybe I'm wrong. Maybe I don't know anything. Maybe you don't agree with me. But maybe if we look at the technicals of this chart and we actually use our brains that the dollar is the world reserve currency, maybe I'm right and the whole world is wrong. And all of a sudden, one day in the next couple of years, we're going to see some crazy shit happen. And if you listen to me even a little bit, you know, which this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. But if I'm right, you might just be rich. I know I will be. But the truth is, the narrative right now is, and the Federal Reserve and the government have pushed this narrative. Think about it. The whole economy and everything went into a massive deflationary spiral. Everything was crashing. It was all closed. All stocks were selling off. Crypto was dumping. Everything was just capitulating. Okay? Everything capitulating. What was the narrative that the government that can definitely be trusted and definitely would never lie to you, or the Federal Reserve, which can definitely be trusted, or any other reserve bank around the world, or the IMF that can definitely be trusted and would never lie to you? Since then, they have been pitching two things. They've been saying everything is going to cost more than it does now in the future because of inflation. And then they've also been pitching, well, there's some inflation, but it's not that bad. But real, like wink, wink. But in real life, they know that there's massive amount of inflation. They even say on their mission statement that they want inflation. That's their goal, is to get inflation. They've never been able to get inflation. So what they did was they basically bought mortgage-backed securities and they bought treasury bonds to force inflation to happen by dumping massive amounts of liquidity into the system. Well, what were they really doing? They really weren't even inflating anything. They were really just, you know, trying to maintain the inflation that was already in the system. They were trying to maintain all the bubbles. They were trying to maintain prices. They were trying to stop the world from going into a giant deflationary cycle or, you know, Great Depression. So in all reality, the narrative for the last year and a half has been there's tons of money for everyone and there's going to be tons more money in the future and everything's going to cost more money in the future and there's all this inflation because everything's always going to cost more. Well, everybody that knows how an economy works knows that if everything is going to keep costing more and more in the future, people are going to go into business in whatever that is. And eventually those things are going to level out and find like a neutral position. Now, maybe it's way higher. Maybe houses are all $1 million in the future. Sure, definitely a possibility. But eventually, if houses are $1 million and the things that you use to build the houses are less than $1 million, people are going to build more houses until eventually it's met. And we're going to see that all throughout all different markets. Things will adjust based on technology, et cetera, et cetera. So it's unrealistic to think that everything is just always going to be extremely expensive all the time forever in the future because of inflation, which the Federal Reserve wants, which the Federal Reserve has caused, because we know how supply and demand works. There's Peter Schiff says this better than anyone else in the whole world. He says, well, there's basically, his argument essentially is there's always demand for things. Everybody wants everything. All humans want everything. Do you want a Ferrari? Do you want a Lamborghini? Do you want $1 million? Do you want gold bricks? Do you want Bitcoin? Of course you do. Everyone wants everything. We all want a house and a Ferrari and all this stuff. But what stops everybody from having one? Well, supply and demand. And so if there's only so many Ferraris and the price is $250,000, only so many people are going to buy those Ferraris. So if all of a sudden everybody gets $250,000, the price of those Ferraris is going to go up because there's still only so many Ferraris. So that's what's been happening in the world recently. The prices of everything are going up because there's only so much of everything and we're just pumping out massive amounts of money, but we're not making more of those things. So over time, even if we keep pumping out massive amounts of money, if we start going back to how the economy was before and we keep making those things, eventually prices will level out somewhere along the way. So everybody always wants everything. And in the meantime, we've been pumping up all these prices by giving everybody money. So what could stop that from happening? Well, if all of a sudden more supply comes online, that's going to meet the demand. Everybody that wants something can get it then. Or alternatively, the liquidity disappears from the system. There's not as much money to buy, so the prices come back down. So again, they level back out, and all the people that want to have that thing can have it. But at some point in time, there has to be a leveling out of things. Things are not just always going to be exponentially more expensive like how they have been overall. So what we did basically was we curbed supply for, a year and 8 months, a few months on some things, and then opened back up. And then we kept demand at the same level by giving everybody a bunch of money. In many cases, we increased demand by giving people more money than they would have had, or letting them stop pay their bills and then giving them more or the same amount of money they would have had. So we increased demand and we decreased supply. So that's why prices have gone up crazy. But in the future, let's say you got a bunch of free money and you didn't have to pay your rent or your student loans or anything, so you bought a new car. Well, great. So next year, are you going to buy a new car, or the year after that, or the year after that, or the year after that? Probably not. So what really happened? What really happened was we pulled forward demand from the future. Okay, so only so many people are going to buy a house in the next couple of years. Only so many people are going to buy a car in the next couple of years. Only so many people are going to buy so much bleach or clean wipes or whatever in the future. People stocked up on all types of things, or bought things that they were expecting one day to buy, or bought things that they thought they were going to need or whatever. So slowly over time, as things start to normalize, in the future, we're going to see that deflation kick back in, because we've always been in deflation. The Federal Reserve and other banks have not been able to hit their 2% inflation targets by their metrics. You could argue they have hit it every year, but by their metrics, they've not been able to hit that 2% target for decades. So why are they all of a sudden going to be able to hit it? They're not. Things are going to go back to somewhat normal. Does that mean prices are going to go back to where they were on everything before? No. But the fact of the matter is, we have pulled forward a bunch of demand, and eventually in the future, supply is going to come back online, and we're going to have more supply because prices on everything are so high. Everybody's going to want to make and sell everything. And then we're going to have less demand because we pulled forward a bunch of demand by giving people a bunch of money. So if we all of a sudden have more supply and less demand, arguably we're going to have more deflation, or arguably, my macro view is, we'll have stagflation. Things like food, necessities, stuff like that will be more expensive. And then things like, bicycles and cars and junk that people don't need that they just spent, like, consumer discretionary type items or whatever, are going to deflate, including things like real estate, possibly things like cryptocurrencies or stocks or whatever. But if you look at the actual stock market and then you start looking at prices based on like the actual valuations, and we'll get back into technical analysis shortly. I just wanted to talk about this today. If you start looking at actual valuations and stuff like that, well, things are priced at record high valuations right now. A lot of things are priced based on, typical like valuations, which are like price to earnings, but some things are based on price to sales because they don't even have earnings. So if we're at record high, price to sales or price to earnings, and then in the future, we're going to have less demand or more supply online, most companies are going to make less money. And then if we also start raising taxes to pay for all the free stuff and all the socialist programs that we're doing now, then, companies are going to make less money percentage-wise. So their margins are going to be worse. There's going to be less demand, and we're at record high, valuations or, multiple expansion, quote unquote. So the likelihood is that everyone has been telling us, everyone has been acting like everything's going to be more expensive in the future, and there's going to be all this inflation, and if you want something, you better buy it now. But in all actuality, what we really did was we just propped up the economy because we were afraid that things were going to cost so much we wouldn't be able to purchase them in the future. But in the future, actually, things are probably going to be way, way cheaper because there's going to be almost no demand. It's like they say, the best cure for higher prices is higher prices, because eventually you're going to kill demand because the prices are too high. So in my opinion, we're getting ready to go into a massive stagflationary period, and we're probably going to go into a depression. And when you look at, honestly, technology is deflationary, but that's a good thing. back in the day, again, Peter Schiff says it perfectly. Back in the day when a car first came out, no one could afford a car. It was only for a couple of people. Same with the cell phone. When a cell phone first came out, cell phones were extremely expensive. Most people couldn't afford them. But over time, they became cheaper, and then market went up because there was way more people that could afford a cell phone when it was $1,000 or free from a service provider than when it was a couple $1,000. So over time, technology is naturally deflationary. So if we have that factor for deflationary, then we've already pulled forward a bunch of demand, so that's deflationary. Plus, we're going to put a bunch more supply online because prices are so much higher on everything. So now everybody's going to make more stuff, assuming they can sell it. And then on top of that, we have, I don't want to say a decline in population, but we have a decline in the speed of population growth. So we're more people, but we're making those more people at a slower rate. Who's going to pay for everything? Because again, that's going to end up being deflationary or disinflationary. We'll still have a population that grows, but it will grow at a slower and slower pace. And if you start looking at the population statistics, you'll notice that, during like the roaring 20s and the late 1900s or early 1900s rather, that you were seeing population pick up massively. And then during a, recession or depressionary period, you see population growth start falling off a cliff. And then again, we're starting to see that same trend happen. We saw a big boom going up towards the 2000s, and population growth, in the United States and worldwide was going at 3% and 5%, depending where you're at, etc. And now, leading up to this recession that we went into, over the last few years, it has decreased down to like 2%, some years 1%, other years 2, 2.5%. But we're seeing that same cycle taking place. So if we don't have more people, that's going to be naturally deflationary. Plus technology is naturally deflationary. Plus there's going to be more supply online. That's going to be, deflationary. And there's going to be less demand because we pulled forward a bunch of demand. So that's going to be deflationary. And then prices on, the stock market and people's wealth and their savings and all this stuff's going to go down. That's going to be deflationary. So, just be careful if you believe all the bullshit that we're being fed right now. But let's jump back into it and rip through the rest of these assets because I know this is going to go long. We're at